UK, but specifically about capital gains tax creep. Um, we've got a situation in the UK where uh, income tax was introduced 300 years ago in the 1700s. And since then, capital gains tax was introduced in the UK 60 years ago, 1964, by the Labour government, and then inheritance tax subsequent to that. So now we have tax on income when you earn it, tax on investments when you make a profit on your investment, and inheritance tax when you die. So tax in the UK, and the tax creep has been progressive over the last 300 years, and it's ratcheting up again in the UK, which is counterintuitive when you look at some of the things that are going on within the world. When you look at jurisdictions where in the Middle East and in America, where they're looking to drive down towards a no income tax, but maybe a sales tax to get the revenue, or does the government need to do the service, or does it need to be done privately? But that's what the tax creep is for, is to take taxpayers' money to pay for the service to be done for the taxpayers, rather than paying for themselves. So it's an interesting scenario, political debate. Won't get into there. Let's look at the tax creep in the UK. Now, expats from the UK or with assets in the UK can avoid paying the additional amounts of capital gains tax. Uh, residential property capital gains tax, some major changes were made from 2015, and they've been progressive over the years. And so now there's a distinguish where residential property has different capital gains tax regime to other types of capital gains tax investment. So you're selling a business, it's one slightly different set of rules. Selling an investment or something valuable, that's another set of rules, and residential property is another one. So the tax creep on residential property is the most dramatic, in that uh, um, the last government introduced a property residential capital gains tax rate of 18% if you're a basic rate taxpayer, 24% if it's high rate tax. So if you sell a residential property in the UK, and your capital gain, your absolute profit since 2015, is more than £50,000, or your cumulative income, it takes you into a high rate tax bracket. So you're getting up to 24% again. So if you've held on to property for 10 years, you made £100,000 on it after buying and selling costs, then that real gain is taxed at 24%. You own UK residential property. Now, there's still a relief, a principal private residence relief. So if it is your own main residence, then you can still get that relief at the moment. That hasn't been withdrawn, that's still maintained, but expats living abroad, where they're keeping a main property in the UK, that's now been double taxed for council tax. So your council tax bill can double from 500 to 1,000 overnight, because they're treating it as an empty property. That's another backdoor way of the tax creep. The scenario is, though, is that would they then start defining those properties which have been assessed as being vacant as being not the principal private residence? It's a question mark. It's a speculation from me. It's not in UK law, but that principal private residence relief on capital gains tax for your residential property. If you're an expat abroad, it's a question mark of whether the government would change that rule at some point in the future to bring those properties under capital gains tax as well. Not the law, not even being talked about, but it is a potential when we see that expats who've got a principal private residence maintained in the UK but as vacant, we've now got the local authorities charging up to double local taxes on that empty property, and that's a progressive taxes creep that's going on in the UK for people that own a property, not renting it out, but it's empty. So residential property is a fixed capital gain in the UK, and you will always get that capital gains tax liability essentially as a fixed gain from the 2015 price. So what a house was selling for in your street in 2015, the difference is the gain, and it's potentially 24% if that gain is over £50,000. Where else? Let's look at another issue of capital gains tax creep. So we talked about capital gains tax creep on residential property, um, but it's not just that. We've also seen in the Halloween budget last October 24 their capital gains tax for everything else has been increased from 10% to 18% in two stages. So by April 26, any capital gain made after that date is going to be at the full 18% rate um, uh, on that capital gain. So that's an 80% tax increase, 40% immediately on any capital gains going through now, they're charged at 14% through to the end of next year, and then 80% the year after. So it's a massive increase in the potential capital gains tax liability from the Halloween budget, 80%. Um, People don't realise it because you pay the tax when you sell property, business investments, and, and then have to pay the bill. Remember that the tax compliance with capital gains means that, especially with any property sale, but any other type of capital gains, is technically reportable within 60 days, and the tax payable within 90 days. Um, so you know the expenses can be quite high. Um, what can we do about that? So we summarised and discussed that capital gains tax has jumped from 10 to as much as 24% for assets owned in the UK. So can UK tax residents or UK non-tax residents avoid the capital gains tax? Well, yes, you can, but there's rules to follow. Um, when you go expat, there's a statutory residency test which determines whether you're tax resident in any year or not. Now, if you're tax resident in 1 year, it doesn't particularly mean the end of days for you, but it can have quite severe implications on your domicile, as well as your tax residence and your liability to capital gains and the inheritance taxes associated with that. Okay, but if you are non-tax resident outside the UK, then potentially you can dispose of some UK assets and avoid a capital gains tax liability. What do we mean by that? And don't forget, this is under the current laws. We're talking in April 25, what the rules are. And if we get a Halloween budget in 25 or some tax changes in 26, it could be refined further. So stay in touch with us at productpartnership.com, and you can contact us to discuss any of these issues at any time. So um, if you want to avoid a capital gains liability on an asset that you want to dispose of in the UK, which is potentially exempt, so it could be a share portfolio, an investment portfolio, it could just another commercial investment, then potentially what you could do is you have to be non-resident before you do the disposal. And it's more than that, you have to be non-resident in the UK, non-tax resident in the UK, the year before you make the disposal. So in April 25, if I leave the UK and sell a property next week, sell an investment next week, the capital gains tax is still going to be potentially liable because I'm still resident at the moment. It's the same tax year. So you've got to be outside the UK as a non-resident under the statutory residency test before you make any capital gains disposal. So in simple rules is if you leave the UK in 2025-26, sell the capital gains asset after the 6th of April 26. Bearing in mind, your intention is part of the rules of the game. If you're leaving the UK with the sole intention of avoiding the capital gains tax, the UK can still claim that on you. And if you don't follow through with your plans, then it can still capital gains tax for you. But you have to, above all, the first thing is that you have to be non-resident from the UK before you have an intention that's provable, an intention to dispose of that asset. So if you've got a property on the market, you've got an agreed buyer, or a business on the sale, an agreed buyer, or you've in touch with your broker, you said, can you set up this sale for this future date? You can't then leave the UK and try and claim to be exempt, because that won't work. You've got to make the first decision is to become non-resident and not non-tax resident to the UK. So that's the first step. There is something that we call magic at ProAct with our tax advice called a split year. So within a tax year, um, you could qualify for split year arrangement. So you could leave the UK, let's say on the 1st of July, and you end up getting 2 tax years. You get April to June is your tax year in the UK, and July to March the following year is the tax year in your new country of tax resident. So if you leave the UK, become legally resident and tax resident in another country with a double taxation treaty with the UK, then you can qualify for a split year. If you qualify for a split year, then your capital gain sale within that split year can be exempt from UK liability. Now, that's an issue. Okay, you need to bear that in mind. That is a big issue. Is that what we said before was that if you're leaving the UK with the intention of creating the capital gains liability, you will still be charged that liability. And the case law on that is very clear, going back to 2002 with John Hargreaves and Matalan share issue, where he got some inappropriate advice and that landed up with a very big tax bill, even despite challenging and down for 20 years. Okay, so you need to consider that what the liability would be. So at ProAct, we always recommend that if you have got an intention, give it as much time as you can, and better to wait for a full tax year before you year end to elapse before you consider that UK disposal. The next thing I want to discuss, just to clarify this, is that if you are leaving the UK, we talked previously that capital gains tax is always fixed in the UK. It's not just for residential property, but any land and property disposal in the UK can be tied to a fixed capital gains tax liability. But in addition, if you're selling a business as an expat and the trade or the branch operation you're selling is in the UK, again, that can be fixed into the UK. Some asset disposals are not, they're fixed in the UK, so it's going to be a capital gains tax liability, even if you've left the UK. So the first thing to do is to leave the UK, then consider the issue about whether it is going to be capital gains tax exempt, and then let's consider what the next step is. Now, if you've gone expat, you've done the capital gains tax disposal the next year, and you stay outside the UK, then the capital gains tax won't be applied. It may be assessed, and you may still have the capital gains tax liability at 18 or 24%. So we're talking about if you've got a capital gains liability of 100,000, your capital gains tax is going to be 24,000. If you've got a capital gains tax of $1 million, it's going to be 240,000 just on the capital gain alone. So if you've got that liability, you've got to stay outside the UK for a long period of time to do that. And that means at least 5 years. Okay, so let's have a look at that in a bit more detail. We said before that a split year can be used as one of the first years. We recommend being on the cautious side, but timing is everything. Uh, don't plan. You have the idea, but don't plan and initiate the capital gains disposal until you are non-resident. But then you need to be permanently resident. If if the assessment is that you've been tax resident in the UK, um, and you're only temporarily not resident because you've not been outside the UK long enough, then they potentially they can tax you again for on that capital gain, even though you consider yourself to be non-resident. So if you've not been outside the UK for full 5 years, you've had this temporary non-residence period, then they're still going to be wanting to tax you for that period and that liability. Um, for example, uh, if if you've been uh, tax resident in the UK for 4 out of 7 years, including split years, um, you're going to be deemed to be tax resident, even if you sold the asset within one of those 3 years that you're away from the UK. So, um, temporary resident, you will be deemed to be. If your lifestyle is one where you're in the UK for a couple of years, you go and leave the UK for 2 or 3 years, then go back again to, to live on the funds. That lifestyle change, because there's not a long enough period, because you've not been outside the UK long enough as an expat, then the capital gains liability will become payable. Okay, um, so in essence, you need to be outside the UK for 5 full tax years. So to be absolutely sure, um, uh, we would always recommend 6 years uh, to be absolutely sure that you're not going to fall in within any trap. So you can have your intention, you get over the end of the tax year, and you've still got 5 full tax years before you go back. So if you make it 6 years, not including the year that you're outside that you leave, then 6 years will cover it. Even if you're leaving at the end of April, 6 years will still give you 5 full tax years outside the UK, and that's the minimum that we would like to see. So what we would what we'd say is if you're intending in January 25 to leave the UK, then what you're going to need to be is outside the UK as a non-resident till um, until 2032. I couldn't say it. 2032. So another 6 years after April 26 to be absolutely clear and sure of a capital gains tax. You can get a split year this year potentially if that's confirmed, and then you do your capital gains disposal. That could still work. We would recommend waiting until after 6th of April 26, but that's the thing. So um, that will be the way to manage the process. Um, Having said all that, if you're tax resident in another country with a double taxation treaty, that determines what your tax liability is. So if you move to a country which applies capital gains tax or any similar tax on the profits that you're making, then obviously you're going to get a liability there as well. So therefore, you need to consider where you're relocating to and what the advantages are there. So the PROACT European office is in Cyprus, not least because the English law that prevails there allows for international trusts, which are very tax efficient. Even so, even if you're not using a trust for your holding business and property and investment assets for the family, um, even as an individual, there's no capital gains tax in Cyprus on investments. So if you're a tax resident in Cyprus and you're disposing of capital gains that are not fixed into the UK, then you'll get 0% capital gains tax liability. And you could live in Cyprus for 5 years quite comfortably and not be tax resident in the UK and mitigate that potentially 24% capital gains tax over those previous 4 years. There are other jurisdictions where you can do that as well. But obviously, if you go to a jurisdiction with any sort of capital gains tax liability, you can't mitigate the cost of the UK. So depending upon your family and business and personal preferences, that country, that jurisdiction may have a consideration, may have a lower capital gains tax. You really choose to pay that rate instead. These things are possible under double taxation treaties. Um, so capital gains tax is creeping up. The rate is creeping up, whereas we could get away a couple of years ago with a 10% capital gains tax. Now you could pay as much as 24%. And don't forget, the tax creep also goes on your inheritance tax. So inheritance tax is a capital gains tax when you die, and it's a 40%. So if you look at it a different way, capital gains tax, yes, it's great, it's 24% maximum, but actually it's not, because if you die and you've got assets and you're deemed to be UK domicile, or those assets are fixed in the UK, they're assessable for inheritance tax at 40%, because again, there's got fixed personal allowances each year. So if you've got £1 million, you've got the personal allowance, but you've still got potentially nearly £280,000 of inheritance tax to pay. So the tax creep goes on income, on investments, and on debt. And only by planning ahead, looking forward with your family to manage your assets across border for UK expat, can you protect yourself from the tax creep on capital gains? For more information and guidance, contact us at proactpartnership.com. We offer free reviews to all new clients. So if you want a 30-minute consultant with one of our international tax experts, you can contact us at proactpartnership.com, book a free review online. If you want to do a deeper dive and look at more services, then we can do that as either a paid call or report or return services, including managing property, business and tax and residency abroad. So go along to our website, proactpartnership.com, contact us to book a free review or an advice call with a consultant, and we can help and guide you to minimize the effect on tax creep for you and your family. To finish off today, there are ways that you can avoid the capital gains tax creep, which sometimes aren't that dramatic. If you make gifts to family or to charity or during your lifetime, then you can avoid potentially capital gains tax and potentially inheritance tax on death. Again, the UK government are trying to make changes and trying to tie up people from the UK to be rolled up inside these taxes. And there's further changes to be made in the current tax year 25-26, which is open to consultation, and maybe another Halloween budget in October 25. We will see. But meanwhile, there are ways you can gift. If you want to keep control of your assets when you're giving it to a family, then you can use a family trust, and a Cyprus International Trust will not charge you any capital gains or income or dividends taxes on assets worldwide. Plus, your business is not going to suffer the progressive increase in the capital gains taxes when you dispose of that as well. If you've got a trust, you can avoid probate because the trust doesn't die, it's just taken over by the family. The thing to remember is that if you want to drive a nice car, you don't need to own it, you can hire it. You can go and hire a Ferrari and drive that around, that 400,000 Ferrari around, and enjoy the experience. You don't need to own the car. You just need to have access to the asset, to live in the house, to drive the car, to live off the income. And this is how to manage your investments. Uh, you can pay professional companies to manage your investments and your pensions and your property portfolio. You can manage it yourself as a family and protect yourself from capital gains and inheritance tax. For more information and guidance, contact us at proactpartnership.com. Thanks a lot for listening. I hope you enjoyed this latest episode in our tax creep. We're going to do another one next week, looking at more detail at the tax creep on inheritance taxes, although that's an ongoing saga where it's extending to pensions in 2026. But join us then and follow us and contact us at proactpartnership.com for more information, guys, for UK expats living and working abroad.